When I say the word mutual funds, what's the first thing that comes to your mind? Every time the match starts, this ad comes.
Remember the disclaimer. Mutual funds are subjected to market risk. Read all scheme-related documents before investing.
As Indians, we've heard of the term mutual funds a lot. From our friends to our relatives, even our parents. But do you know when this 75 lakh crore industry actually began? Let's rewind a bit. The year is 1963. Imagine India in black and white now. The economy is fragile, but optimism is in the air. The government of India launches something historic. The UTI, the Unit Trust of India. Created by an act in Parliament and backed by the Reserve Bank of India, the UTI just had one mission: to give ordinary Indians a chance to invest their money. And in 1964, UTI launched its first ever mutual fund scheme, the US64. Now, why was this a landmark move? Because up until that point, Indians only trusted physical assets like gold, silver and real estate, bank FDs and government-backed savings schemes such as postal deposits, and of course chit funds and other informal savings groups. But now for the first time, Indians could pool their money into professionally managed funds, investing in companies such as Tata Steel, Hindustan Lever and even Indian Oil, stable companies with solid returns and good dividends, perfect for cautious investors. Now let's put that into perspective. In the year 1964, India's per capita income was just rupees 300 to 400 rupees a year. That's about $50 to $60. Out of a population of 480 million, very few could afford to invest in mutual funds. In fact, in the very first year in 1964, US64 was able to mobilize just rupees 1 crore. Less than 0.1% of the total population were able to invest. And most of the investors came from cities such as Chennai, Delhi, Mumbai and Kolkata. Cities which were already urban centers and had sufficient amount of knowledge and awareness for this. Rural India? Hardly touched. Awareness and access was just too limited. But even then, a change had begun. An evolutionary shift had just started. And people's habits, especially their investing habits, were starting to change. And trust was slowly starting to being built. For nearly 3 decades, from 1963 to the early 1990s, UTI and its US64 mutual fund scheme was the only option in the market and held a complete monopoly. If you wanted to invest in a mutual fund, US64 was your only option, and thanks to the government backing, people believed in it. But then the year 1991 rolled in. Economic reforms and liberalization happened. Private and public sector players were suddenly allowed to be a part of the mutual fund industry. Players such as SBI Mutual Fund, ICICI Mutual Fund, LIC and even Punjab National Bank were all part of the mutual fund industry now. The Indian investor finally had options. But while the industry was finally opening up, UTI's golden child, US64, was slowly sowing seeds of disaster. By the late 1990s, mismanagement, shady practices and poor investment decisions had finally caught up. In 1998, the US64's reserves were negative. The prices at which units were being bought and sold did not match the real asset values. In 1999, the government had to bail out UTI with 3,300 crore rupees. But the problems just didn't stop there. Then came the dot-com crash of 2001. The US64 had heavily invested into tech stocks. And by March 2001, those stocks had lost more than half of their value. Investors began to panic and redemption requests began to surge. The UTI had ran out of liquidity. In July 2001, UTI did the unthinkable. It froze out all of US64's transactions for 6 months. Imagine, you couldn't even withdraw your own money. And the public outrage was massive. A joint parliamentary committee had conducted an investigation into all of this. And in the year 2002, they discovered lapses. Finally, in the year 2003, the UTI Act was repealed and US64 was wound up. Investors were compensated with bonds, but the trust was broken. But this crisis was a turning point. SEBI had finally stepped in. Regulations were tightened, and protections for investors had improved. Out of the ashes, India's modern mutual fund industry was finally born. The UTI became the UTI AMC, now just one among many players, all of them regulated by SEBI. As of June 2025, India's mutual fund industry has an AUM, asset under management, of more than 75 lakh crore rupees. Every month, more than 3 to 4 lakh new investors enter the market. In August 2025 alone, SIP inflows saw more than 28,000 crore rupees. The equity mutual funds alone saw net flows of more than 33,000 crore rupees. Now let's compare the returns of mutual funds versus other assets and instruments over the last decade. Nifty gave 12% CAGR, Bank FD 6 to 7%, Gold gave 12.1% and real estate gave 5 to 7%. Clearly, we can see that mutual funds have become a mainstream wealth creation vehicle. FDs give about 6 to 7% in returns. Mutual funds, however, give about 12 to 15%.
Interesting. I actually plan on investing in gold.
You can invest in gold through mutual funds.
So the journey of mutual funds in India has been anything but smooth. From being a monopoly under mismanagement to a crisis to now credibility. And now the mutual fund industry in India is worth more than 75 lakh crore rupees of assets under management. And if you are curious or are wondering how to start your mutual fund journey, we here at Shree Consultants are happy to help you. Click the link in the description and our team will get in touch with you to give you a customized mutual fund growth strategy to help your wealth grow in the next 5, 10 and 15 years. Because when India grows, your wealth should too.